Commercial real estate lending has surged almost 50% year over year, but buried in the numbers is a $2 trillion debt bomb set to mature in the next 2 years. Sounds like a boom, but the reality is dangerous. Most of this new debt layers on a massive maturity wall.
Yeah, man, $2 trillion in commercial real estate loans are maturing by 2027. $591 billion in 2025 and 2026 are actually flagged as potentially troubled. And those are loans that were issued or originated during the real low interest rate era. And they're calling this a, quote, maturity wall with over $1.5 trillion maturing by the end of 2026. And I get this next data point stresses me out a little bit. Commercial loan obligation distress rates are already rising. 11.8% are in distress and 9.2% are delinquent. Dude, and 65% are past maturity. And not surprisingly, office sector is the worst exposed with weak demand, falling rents, and vacancies rising. This is something we need to talk about for sure.
Well, I got to say, we've talked about this in our mastermind several times. Debt is a tool, but it can also be used against you. And I remember, Travis, we were investing 2-3 years ago in the low debt environment, and brokers were calling us crazy because we're like, look, we need to have a spread between our returns cap rates and our current debt because we expected debt to go up. In fact, during the COVID years when we saw all the printing happening, right? And this is literally a conversation we had inside of our elite mastermind just like a couple weeks ago. When we saw all the cash coming in, we expected inflation, which was true. It happened. It wasn't this temporary thing. And to combat inflation, right, exactly. So, and to combat inflation, the Fed raises interest rates, right? That's their one sort of lever to combat inflation. And therefore, your returns go down when you have to refinance. I think everybody was good for a little while because debt's maybe 5-7 years, but now we're there. And a lot of these guys are going back to the banks going, hey, I need to refi. I got a 3%, 4% loan, maybe 4% loan. And they're facing a 7-8% loan. That's a massive, massive problem if they haven't been able to financially engineer that property to support that debt. I'll give one example. We have a property in Florida we just did a refinance on, and we made sure we had a big delta because when we go to refinance, we thought the interest rates were going to be more. That's exactly what happened. But we're fine on that property. We have great debt service. We have great cash flow because we built that in. So this is definitely a topic of conversation that we have in the background as well as inside our elite mastermind. Like, guys, when you take on debt, you cannot underwrite the property like that debt's going to stay the same cost over time.
Well, let's talk some of these consequences. I mean, I said 4 times. I think in most cases, it's more like 2 times or sometimes even 3 times. I think 4x would be an extreme example, but a lot of loans at minimum are doubling. There's a lot of people that locked in 3-4% money, and those are, 7-8%. And these loans have started maturing. What do you guys think some of the biggest consequences are to these folks that locked in low interest money, slim returns, and now those loans are set to reset? They have to refinance. For those that aren't familiar with commercial lending, most commercial loans are 25-year amortization, but those loans are due in 5 years, meaning you have to refinance at that 5-year mark and get new financing. So if you locked in a 3% rate and now rates are at 7%, well, shit, does the property work? And if not, what do you do?
Well, we saw this a lot where people would be bringing deals into the mastermind. By the way, if you are interested in joining our mastermind, the Elite Mastermind, there's a link below if you want to be a part of that group. But one of the things we do is we stress test these deals. Right? You got to be forward looking. We're going to be talking backwards looking on this show today, and then use the lessons learned over the last several years to help people maybe listening to this how to navigate this going forward, because there's threats and opportunities for sure, but stress testing a deal is important. And to Mitch's point, we would look at a deal and say, okay, well, if rates triple, what is that going to look like? But we saw syndicators bringing us deals and they were underwriting their debt takeout in 5 years at the same rates. And that's where I think understanding the fundamentals of debt, because debt can make a great deal crappy or a crappy deal pretty good. So, micro consequences, obviously, number one, the biggest elephant in the room is the refinancing shock, right? There will be defaults. People will go to refinance. They bought these things on slim margins and the debt service is too high. The net operating income or the profitability in the property won't support it. And banks I see a lot of people having to do major cash in refinances because the banks are looking at these things going, okay, we'll lend on this asset, but there at least needs to be a 25 or 30% delta between the profitability and then the debt service. And if you can't do that, then the banks are going to want you to come in with more money. And a lot of people don't have. It could be $1 million they have to come in with on a refinance, and then they just hand the property back to the bank.
So that was going to be my question to you. Like, you're a big baller real estate investor that you're sitting liquid on millions of dollars and you can do a cash and refinance. But there's a lot of investors out there that are not in a position to do a cash in refinance. People know all about cash out refinances. You pull money out because your property is worth more or the lending's cheaper. But a cash in, like, nobody wants to do a cash in refinance to hold the property. And there's a lot of people that are not in a position to do a cash and refinance just to keep the property. So I think the big question is, then what? What are investors going to do? What are the banks going to do? I mean, we've said this time and time again, like, banks don't want these properties back on their books either. Like, the banks have learned. So, like, what happens when you have an investor, they're backwards on the property, they're going from 3% money to 7% money on a refinance, and the bank says, hey, you need $1 million to keep this property. And they say, well, I don't have that. Here you go. Here's a property back. Then what? What are the banks going to do? What do you guys think the banks are going to do in that situation?
Well, I'll start with, I want to get away from the banks for 1 second, then get to that. I think one of the options that people are looking at is they're just going to sell the property and they're going to lose the equity, either their equity or investors' equity, plus potentially come to the table with money just to offload the property. So you could sell the property and still have to go pay because you owe more on debt than you sold the property for. Because when interest rates go up, cap rates go up, property values go down. So one option is just to lose all the equity, whether it's your equity or investors' equity, which is obviously horrible. I don't think the banks want the properties. I think the banks learned their lesson. I mean, I hope they learned the lesson in 2008. They can't operate properties. In fact, they took control of a lot of assets and they ran them into the ground. They made them worse. So they made the underlying collateral worse. I do think that there's some banks and some operators or some situations, I should say, where the banks will work with the operator potentially. Potentially, there's an interest-only option for a couple years while they reposition the property if there's some sort of financial levers there. It was interesting during COVID. When everything was going crazy, we had banks calling us going, hey guys, first of all, how your property doing? Second of all, can you pay the debt? Third of all, we'll work with you if you can't. I don't think banks want the properties back. Now, if they do take the properties back, I think what they're working on is inside relationships with other good operators that they can literally take the property and transfer to the other owner, like straight across, potentially taking a loss on the books. While transferring that over. So maybe it's like, hey, there's $1 million owed. We're going to transfer this over and take $800,000 and take a bit of a loss for this new investor. But I think the last thing they want to do is take properties. I think they learned their lesson in 2008 and I don't see that happening.
Well, I've talked to other operators that might have a property or two in distress, specifically in Texas, actually, very specifically in Texas, because in Texas, you have an issue where you've got this debt ceiling where refinancing is too tight, but then the issues are compounded with the fact that you've got rents that are lower, actually, because there's been oversupply in these markets. Vacancies are higher. So not only is the debt service double or triple, but the net operating income has been cut in half because the income's down and expenses are high. In a lot of these markets, these Sunbelt states or Texas we've talked about, insurance premiums can be double or quadruple the amount. So these people are just, they're squeezing. They're squeezed. But I'll tell you, the few examples I know, the banks have actually said, like maybe we'll revise the rate down, maybe we'll extend the amortization, maybe we'll back end interest on the exit in 5 years. Like there's loan modifications. I have a commercial real estate where I knew this was going to happen. I locked in, I had to refinance. It was a seller carry. And I got locked in at like 7.25%, and that sucked, but I did it. And again, I stress tested the property. It worked at 7.25%, but it sucked. But I also negotiated a rate reduction. So if the rates came down, which they have, and I just signed yesterday for a 1.25% lower, I just reduced my debt service on that by $2,000 a month. But I don't know. Yeah, I think banks are going to work with you, and or if they've got good operators in their pocket, they know that these operators can take it and add value, get the NOI back up, and operate these things effectively. That might be a great opportunity for people that understand the fundamentals and understand how to operate these assets.
Well, I got a question too for you guys. Let's say someone's listening to this show right now and they want to go buy a property at 6.5% debt. and we know, let's just say we know in the next 2 years, debt's going to, or the next 5 years, debt's going to 8 or 9%. How does an investor prep themselves for that? Like, what does that look like to like build in a buffer in case interest rates do go up? Because everybody thinks, oh, rates going to go down, rates going to go down.
No,
Like, yeah,
no.
and maybe they will in the short term. That's fine. But like in 5 years, we don't know what the hell's going to happen. We have no
Well, you
idea.
keep printing money. Yeah.
There you go. So as an investor, how do you build in a margin? What does that look like? You're underwriting a property. I'm getting 6.5% debt today, somewhere around there. What does that look like? How do you protect yourself?
I think it depends on the kind of lending. Like we're talking commercial lending, right? But I think back to when I started buying properties, 20 years ago, right? It's like I did a lot of seller finance real estate. So I was locking in properties with interest rates and terms that made sense today. Now, I played the market. I didn't time the market. It looked like I timed the market perfectly because I picked up all these properties 2009 through 14 or through 13 and then refinanced in 2014 when interest rates were low, right? So I was able to increase my cash flow. The market improved. So these properties appraised out. They all appraised out. I remember 70% loan to value or better. So for the young investor doing maybe starting with some of these smaller deals, those residential loans can still be locked in with 30-year fixed mortgages. And so if rates do adjust down, then, my first 10 properties were all 30-year fixed. And some of these were small multifamily. But I got 30-year fixed mortgages. They were fully amortized 30 years, and that rate was locked in. If interest rates adjusted down, I could refinance. But if interest rates went up, I was still locked in. And those properties cash flow today locked in. So for some investors, take advantage of those residential type loans. And, in the rare cases, there are 30-year amortized commercial loans as well. It's not as common. I refinanced several commercial loans and there was a 10-year option versus a 5-year option. So, if you can lock in longer money, in almost every case, do it. I'd rather have a slightly higher interest rate with a longer term, knowing that's locked in, than if it's going to adjust in a couple years. I feel more confident in that. For our newer investors getting into, commercial, like larger commercial properties, you're getting a true commercial loan. You need to stress test the hell out of that. And that may mean like if rates double, again, which I don't think they will. I can't predict. I actually think rates are going to slowly come down over the next year. But if rates were to go up and drastically go up, how far could rates go up and that deal still work? Like, and I think banks are stress testing these properties as well. Like the banks want to know, hey, if things change, and like where are we? How are we made whole? And how are we, not exposed if rates go up, drastically?
Well, I think rates going up is a reality. Personally, look at what just happened. The Feds just dropped the overnight lending rate 25 basis points, but you see the bond market spiked, the 10-year spiked. And never have you seen the sort of decoupling between the bond markets and the overnight rate. And the bond market's really supply and demand driven. And the rates could go up because a lot of commercial loans are based on like the 5 or 10-year spread. So to answer your question, Mitch, I know what we've done, even back in the day when we were locking in 10-year rates or 5-year loans or 7-year loan balloons. One of the things we did is we wanted to buy something and make sure we got it to a 9% operating cap rate within the first 6 months. What that means is we knew we had a very clear line of sight, an easier line of sight, not developing, not infill, but actually a clear line of sight of raising rents, reducing expenses, driving up the net operating income to the point to where that this thing was operating at a 9 cap, at least back in those days. And what that gave us, though, was a healthy debt service coverage ratio. We wanted to see these DSCRs up in the 1.5, north of 1.5, which at the time banks were saying, don't worry about that. Just give us a 1.25 debt service coverage ratio. So we wanted to find something within the first 12 months we could rapidly increase the net operating income, rapidly increase the value. What that gives you is a debt service coverage ratio cushion on a potential refinance down the road. It also gives you a lot bigger value on the property, which so you can bump up the loan to value. On this particular case that you're talking in Florida, we did just that. We went in, we knew we had a clear line of sight. The rents were significantly under market. We raised the rents. We got the debt service coverage ratio up, got the value up considerably. The original plan for that was to actually return investor capital. But we told the investors, look, in this case, if we think rates are going to do what we think they're going to do, don't expect to cash out, but we could at least refinance and keep consistent cash flow. And that's exactly what we did. There was no cash out, but we held the property. Bank's happy. We're happy. Investors are happy. Things are cash flowing and their equity's protected because once that property goes back to the bank, all of your investor equity is gone, like you were saying before. And that worked out well for us. But it all comes down to people want to just look at the upside on deals. It's exciting. It looks good on Instagram, but you have to be a pessimist, and you have to, what happens if rents are down? What happens if it's rates doubled? What happens if expenses increase considerably? And that's exactly what happened.
Well, I was going to say, it's interesting too. Like, I think when you back up and you look at 30,000 foot level, real estate is such a valuable asset that, you could buy $1 million property today that's financed and hold it for 30 years or 25 years or whatever. And it's paid off even without any appreciation. Your tenants have paid all of the debt down and you have $1 million net worth on that one individual property. So when I look at real estate, I used to look at the upside with so much focus, and I still look at the upside, but like understanding, can you just make it? Can you just make it through different market cycles? The people that survive this last market cycle are going to win. And they're going to survive the next one, probably because they set themselves up for success during this last one when interest rates went up, versus the folks who are like, oh man, I'm going to go hard and fast. I'm going to get leverage to the T. I'm going to scale as fast as I can and make as much money as I can. Those are the guys right now that are calling me going, what do I do? I'm done. They're taking my house type thing. So I think like looking at this, it's like, yeah, you got to look at the cash flow. You got to look at the upside. The forced appreciation is all great, but looking at like, what am I walking into day one DSCR? DSCR is such an important metric because it tells us how strong that, right? How many times can that property pay its current debt obligation? And if you're walking into a 1.5 or plus, that means literally you could take on debt that's way, way more expensive if interest rates adjust. So the more I'm into real estate, the longer I'm into real estate, the more cycles I go through, the more I'm going, you got to set yourself up for long-term survival. And if that's the case, you're going to thrive in this game. But if every time the market dips or the interest rates go up or whatever, you get squashed, then you're done. It's over. So anyway, more of a 30,000 foot level.
Well, I do think that it's really enticing and it's alluring to only look at the upside when you're first underwriting a deal, because that's the exciting part. Oh my gosh, I can increase the NOI, I can increase values X. But you really have to be disciplined in at first to say, how do I not lose money? Number one, how do I not lose money, right? And through that, you have to begin being a pessimist. And like Mitch always does, because he's such a salty little guy, he says every deal is guilty until proven innocent. And I hate to admit that he's right, but I would say he's right on this.
Right again.
Right. Well, rarely right, but right on this one. So let's talk about other consequences. So banks are exposed to bad loans. Like people always think about the borrower getting hurt, but these banks will get hurt. If these banks are holding bad assets or they're holding loans that have gone sour, people are defaulting or they're in the rears, like what does that do for banks? I'm already seeing this. In fact, we were talking about this before we went on the air because Gabe and I were on time and Mitch was late, which is common for him. But one of the things we were looking at was like, what happens with the lending environment? I'm seeing banks underwriting these things we have one bank that did a loan with us last year on two park mobile home park portfolio. And they were like, yeah, properties look good. DSR looks good. Great. Let's refinance. We just refinanced with that same bank on another community in Pennsylvania. And that bank was like, we need to see Mitch and Travis's schedule of real estate, their personal financial statement, all their tax. They're underwriting us a lot more. And so getting lending is more difficult right now, which is good if you've got good balance sheets and you're good operators because you can edge out other investors. But what happens when the banks hit a wall? Like, right, are banks too big to fail? Like we saw this in 2008. That was a big thing. And if banks fail, that's the fabric of our financial system.
I think we kind of already talked about it. I mean, I think banks are going to have to start negotiating with investors. If you're a good operator, if you're a solid investor, banks are going to want to work with good investors. And I actually like that the banks are tightening up. I actually like that the banks are, underwriting deals harder. Like I'm tightening up my underwriting. Like I'm working on a deal right now, and Mitch, you asked earlier in the show, like, how do you protect yourself, from a rate increase or, a big shift? And like, for me on the commercial asset, like I'm looking at what can I negotiate up front, whether that be price, whether that be some aspect of the deal. Like right now, I'm negotiating on a deal where we're locked in a 10-year lease, but I'm also negotiating a personal guarantee and some prepaid rent and possibly even some prepaid reserve for debt service, right? And so it's like, the bank and myself and the seller are all working together to find ways to mitigate any possible risk. And so like I'm sharpening my pencil, the bank's sharpening their pencil. And it's really the ability of me as an investor, the seller and the bank to all be creative, but also to mitigate the risk. Because in the end, like we all want to succeed. I want to buy this property. The seller wants to sell. It's a seller lease back. So there's room to negotiate, the term of the lease and different things. And the bank wants to be protected. And I think when you're a solid operator and you have that relationship with the bank, you're in a position to make these changes and negotiate these things that will benefit the property. Large commercial property, one of the advantages is you built in these rent increases, right? And so these rent increases, on a property, on a large property where they're paying a lot in rent, like those 3% rent bumps every year for the next 10 years are pretty significant, So 5 years, from purchase date, you have some debt pay down, rent is increased. You start with a solid DSCR that should only improve over those 5 years, those 10 years. So like, there's a lot of things you can do, especially in this triple net space, that you can do up front to mitigate that risk. That's my focus. What can I do that's in my control before I close on the property and as I close on the property to mitigate every possible risk that I could come up with so that it's better for me as the investor, it's better for the bank, and it's good for the seller as well.
Well, I think a lot of people, when they're underwriting a deal and they're starting to work with a bank, they hold the bank at arm's length, right? They're like, how can we get this bank to lend on this property? And I think the philosophy needs to be the bank is your partner on this deal. And the bank has strict underwriting guidelines. And that's like a second or third set of eyes for you. And I think that's really important because the banks, we tend as entrepreneurs tend to look at things with rose-colored glasses. The banks don't have the upside. All they have is a performing loan and interest rate and fees. So they have to immediately look at the downside. In fact, we have properties that we might buy on an owner contract where the bank's not even involved, but we call banks that we have partnerships with and we say, will you underwrite this? Because we want to use you in 3 or 5 years to refinance this. And it's like another person on your team looking at these things through scrutinizing these assets, which only benefits you. So I would advise newer investors, the bank is your friend, man. Partner with the banks. Look at these assets through the eyes of how the bank would look at it.
Yeah, I agree. I think it's all about like, how do you look at like Warren Buffett. I've read some bios, and he's a stock guy, but really he's just buying businesses, and he's always talking about the margin of safety. Understanding, are you buying undervalue? Do you have the levers to force appreciate? Do you have the ability to make things better? What's the debt you're accepting? I mean, debt's not technically an expense as far as accounting goes, but in the end, it is an expense. You bring in rent and revenue, you pay out expenses and debt, and what's left over, and you need to make sure that you have a really, really clear margin and the ability to increase that to take on debt at a higher cost. I think, like you talked about, like it really comes down to running scenarios. When you're underwriting, look at scenarios. Hey, what if interest rates go to 9% tomorrow? What does that mean? What happens if tenants disappear, or there's some crazy, legislation where, people don't have to, 20% of your tenants don't have to pay, or whatever that is. Like, understanding and stress testing is a really, really important thing, because all you've got to do is grab good assets and survive all market cycles, and you're gonna make it huge in this industry. And most people cannot do that. Most people don't survive market cycles. Most people get squashed. It's the groups or the individuals that survive throughout time that take advantage of long-term appreciation and cash flow on these assets.
Yeah, and I think one other thing, then, Gabe, you and I were talking about this too earlier on this very particular property you're looking at. One easy metric is, especially now, are you buying under replacement cost? I mean, a lot of these assets cost a lot of money to build, right? And so if you, like, I think you were saying the replacement cost on this asset that you're potentially buying, Gabe, is like $11 million and you're in contract for 4.5. Like, that's a huge margin of that's, and David Lindahl talked about that in a book that Mitch and I were reading early on when we were learning this game. Everything he bought, one of his number one requirements was what the asset had to be. The value what you were buying it had to be under replacement cost. So let's talk about some other micro consequences. The broader economy. Okay, let's say that there is commercial lending stress. Let's say properties are going back to banks. Let's say banks are struggling, right? We're seeing that they're getting a lot more conservative. How does this affect the broader economy? How does this affect our tenants? How does it affect the markets that we're investing in?
What do you think, Gabe?
I thought we were gonna wrap the show up because I know Travis has to get on a plane with all the cash flow he gets and all the time he gets from real estate. So I was about to wrap it up, and then for the third time, Travis is like, "Oh, and also
he's always the one asking the questions."
Well, that's all right. We'll finish this, and I'll get on an airplane and fly away from you guys.
I'll give a thought on that, and we can wrap it up. I think that if it's true that multiple investors are struggling, that will affect the economy. I mean, anytime, like you saw in 2008, the housing market took down the entire economy, right? So if you truly had a commercial, if you had debt coming due and people are giving back properties and people are losing equities, investors are losing equity, then I think that that could ripple through the economy, because that affects, when it affects an individual or investors or multiple individuals, then that will ripple. They spend less, they vacation less, they sell houses, businesses struggle, whatever that is. I actually don't think we're going to face that. I don't think that's the scenario that we're looking at. I do think that banks are adjusting the way they approach hard times. And with that, I think that they're being more flexible. They're working with investors. And if the person does give it back, I think that it's a quick transition to a different buyer, a different operator who can operate that property in a way that's beneficial. I don't think it's this huge, banks are taking everything over and people are foreclosing everywhere. The worst of the worst are giving back properties, but I think a lot of banks are working with folks. So I just don't see this massive, colossal wave of foreclosures and hurt in the marketplace like we saw in 2008.
Spoken like a true shaman, Mitch. Once again, you sound smarter than you are. So thanks for tuning in to the 0 to 100 show, and we'll see you guys next time.